Joining us today, Canaccord Genuity Chief Market Strategist Tony Dwyer is with us. Tony, I was curious myself as to whether or not last week made you incrementally more bullish. It doesn't sound like it was much.
Well, it was set up that way, Carl, and thanks for tweeting that out, by the way. The stage was set for a pretty sharp rally. You were historically oversold using our weekly stochastic indicator on the S&P. It rarely gets as oversold as it was coming into last Monday. And you really had three very identifiable catalysts for the bond market. Remember, what drove the market down so much, the S&P 500 10%, the Russell 2000 back to its lows, down 33% from peak, the bank, BKX down, KBW Bank Stock Index down 51% from peak. So all of that movement was created by higher rates, and you had the three catalysts last week that kind of got engaged. Now that that isn't the case, when you look back, it was the best week for the banks and the home builders since early April of 2020, right? So that brings the question, Carl. Well, maybe we can have a bottom like we did then. But don't forget, back then on April 9th, the Fed made the announcement that they're going to be buying high-yield debt. Right? So we're not in that situation.
Yeah, right. To the degree that we get closer to a conversation about cutting rates, and even Kashkari today this morning said we're not there yet, what would you be looking to buy first? Would you go straight to small caps and REITs?
Yeah. So, Carl, the time to get really negative, I know we love to cover it minute to minute on the market, but the time to get really negative was last year, last summertime in August, when, the markets were up high, but the Fed was ramping rates 75 basis points at a clip because inflation was the problem. Inflation's not going to be the problem. At some point in a bear market where you have an economically based bear market, you go from good news is bad news because it means the Fed's going to be tightening more aggressively. We saw that in 2022. Then bad news is good news because it means the Fed isn't going to be raising rates. But ultimately, you really bottom the market, especially in a recession when bad news becomes bad news. And I think that is discounted in a lot of areas. But you can't tell me with the BKX down 51% that some kind of recession or poor lending environment is discounted in the banks. Same with the Russell 2000 down 33% from peak. So, the point is, I don't think I'd be really negative in those areas. The issues you're going to have in the two areas we've talked about is the mega cap tech stocks, which top 10 stocks right now account for 34% of the market, highest level since 1973 in the Nifty 50, and energy, which became everybody's favorite about a month ago.
Tony, you want to see what to make you more bullish? You say in your note the Fed needs to begin stimulating future growth with a drop in rates. But isn't that already happening in the market ahead of the Fed?
Well, so typically, Sarah, you go back even in the soft landing environments, 1995, 1966, even if you want to play around with 2019, you get multiple 100 basis point drops in U.S. Treasury rates, mortgage rates, and corporate credit rates. So it's not just a little bit of a decline, it's a massive decline. And the problem that we have, and you guys have done a great job of covering this today, on mortgage rates, let's talk about that for a second. You got about a 7.5% 30-year fixed rate conventional mortgage. 82% of mortgages are below 5%. You got to go down another 250 basis points to even think about refining. So sure, it will become cheaper for those that don't own a mortgage to buy a home as they come down maybe 100 or 150 basis points. But you need a significant and sustainable drop in those interest rates to kickstart that better outlook for money. And that, guys, the market bottoms in a recession not because the data is getting better, the data gets worse. It's because the outlook for money improves with significantly lower rates in mortgages, corporate credit, and treasuries. And right now, we've got a hint of that. I think it'll be more aggressive into next year. So as you guys know, I'm looking to attack weakness, similar to what we did maybe last Monday, than to try to play big on the downside, because that's in a lot of stocks.